Thanks for joining us today for the weekly Signature FD investment audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. All right, so we're going to start with our chart of the week this week, and we've understandably been getting questions on gold since gold has been on a really solid run the last couple years. And here in this chart of the week, we're showing gold versus its long-term trend, and because of that strong run that it's been on, gold you can see here in blue in the top clip is now pretty strongly above its long-term trend of 5.8% per annum returns. And what the bottom is showing us is it's showing us the price of gold relative to that long-term trend. And we can see that we're now at a level that's pretty stretched. And the statistics in the bottom of the chart tell us that when gold has gotten this stretched relative to its long-term trend in the past, the subsequent 5 and 10-year performance has actually been negative. Now, not hugely negative, but gold has had a downward bias when it's gotten this expensive relative to its long-term history. So that just tells us that we probably want to start to temper our expectations, at least over the longer term period for the yellow metal here. All right, so when we look at other major asset classes, we can see that year to date, many of them are at highs, either all time or on the year. We can see that international stocks have still led the way. The MSCI EFA index, which represents developed international markets, is now up almost 22% on the year, and emerging markets are up a little over 19% on the year. Now, the S&P 500, that's up a solid 9.4% this year, and Russell 2000, representing the small caps, is only up 2% this year. So small caps have continued to be a laggard, and that's something that has certainly caught our eye. Now, when we look at the economic landscape, we have been getting some leading economic indicator data, and some of that data has continued to show that the economy is in line with significant weakness or even recession. And the problem that we have with a lot of the leading economic indicator indices that we track is they're too manufacturing heavy. And the manufacturing sector has been under pressure really since COVID. However, the lion's share of this economy really is in services, and services have been ticking along nicely. So here we're showing an index, the Fiber Weekly Leading Index, which uses a lot of macro variables. It's very sensitive data to get leading economic indicators, and we can see that this leading index is consistent with a continuation of the expansion and is actually making higher levels this year than it had in years prior. Now, will this continue? We can't guarantee that, especially with the dynamics that we're seeing in inflation right now. So, for instance, the goods prices that are more heavily sensitive to tariffs are starting to inflate at a higher rate than they had in the prior few years, and service inflation is starting to come down. So consumers don't have more money to spend. So if goods prices are rising, then it's likely that there's going to be pressure on services prices, and that could have a negative impact on the service sector. We're not seeing it yet, but that's something to keep an eye on. For now, most of the indicators that we think have it right for this economic cycle are saying that the economy is still in expansion and likely to be so for the upcoming quarters and months. When we look at the earnings season so far for Q2, it's been really promising. So on July 1st, what this chart is showing in the red bars is showing July 1st and what analysts' expectations were for earnings for the various sectors in the S&P 500. And then today is the blue bars. So you can see how analysts' expectations have changed as earnings season has really started to get going. And we can see that for the S&P 500, on July 1st, earnings were expected to grow 5.8%. Now, earnings are expected to grow 7.7%, almost 2 full percentage points higher. So that's a really positive trend as some of these earnings have started to come in. And we really see that strength in the communication sector, a little bit in the tech sector, and really in financials as well. So that has been an encouraging sign for the market fundamentals. Even though we've had some encouraging signs from those kind of cyclical areas of the market, we need to remember that the market is a leading indicator. So market participants sniff that out in advance, and they and stock prices act accordingly. And what we've seen this year is a really strong rally since April in cyclical sectors, which are energy, materials, industrials, consumer discretionary, financials, tech, and communication services. There's been a really strong rally in those cyclical sectors relative to defensive sectors. Defensive sectors are staples, healthcare, utilities, and telecom. Now what we can see is that rally's starting to slow down and peter out. And what we're showing in orange in the second clip here, this is the percentage of stocks in those cyclical sectors that are above their 50-day moving averages. And we net out the percentage of stocks in the defensive sectors that are above their 50-day moving averages. So when that orange line is trending down, that means that participation is improving for the defensive sectors relative to the cyclical sectors. And that's to be expected. In most post election years, the market does start to slow down towards the end of the second quarter. And you do kind of run into corrections in the third quarter. So it would make sense that some defensive leadership may start to emerge here recently and in the months ahead. Now, one of the things from an earnings perspective that's really helping out is a boost in buybacks. So this chart only goes through the first quarter, and we can see that just total dollar buybacks or share repurchases were near an all-time high, almost $970 billion of buybacks. So we're talking about really large numbers for share repurchases. And I suspect that here in Q2, this is going to actually hit a new all-time high in dollar value of share repurchases. And that really helps to boost earnings per share and is a sign to the investing community that corporate treasurers see their stocks as attractive right now. Now, one of the other things we've been monitoring, because housing is such a big part of the economy and especially a cyclical part of the economy, and particularly for the job market, we really like construction jobs as something to watch. What we see here is median home prices have now hit a record high level. So for single family homes, that's $441,000. For total existing homes, that's $435,000. So we're at an all-time high, and it's not because there's been a lot of houses moving. It's quite the contrary. There's been a lock-in effect because people have low mortgage rates and they don't want to trade into a higher mortgage rate right now. So not a lot of existing inventory is hitting the market, and that is kind of boosting home prices higher, but at a slowing rate. So we can see in the bottom clip, that's the year-to-year change, and single family homes are up 2% over the last year. That's a very manageable rate of appreciation. So that's what we've got for this week. And some closing thoughts. We gave you a chart of the week, and we showed that gold is stretched relative to its long-term trend, and we believe that that should influence our future expectations around the yellow metal and probably temper those expectations somewhat in the next 5 to 10 years. The U.S. economy is stable, and some indicators are overweighting manufacturing. And those indicators that overweight manufacturing are probably giving too negative of a signal on the economy. The service sector is the lion's share of the economy, and it's been doing just fine. Now, there is inflation in goods, and that's been accelerating, and that could put some downside pressure on service inflation. So that's something to watch going forward, but okay for now. Now, the Q2 earnings season is promising so far, and buybacks are supporting that trend of positive earnings surprise. So that is solid from a fundamental perspective for the market. Now, cyclical sectors have been on a tear since April 8th, but the breadth is starting to deteriorate relative to those more defensive sectors. Now, that's in line with what we would expect in a post election year, but something to monitor nonetheless. Now, the housing industry does remain somewhat frozen. Home prices have reached a record high, but the rate of price growth is easing, and that should help to keep a little bit of a lid on inflation as we go forward. So that's what we have for you today. As always, I want to thank you for joining us and wish you a great week ahead.